Okay, so some interesting things in the news today. Warner Brothers Discovery. Who saw that coming? So they were supposed to sell to Netflix and got a hostile bid from Paramount for 108 billion. So Paramount is the overleveraged company that used to be part of Sherry Redstone's empire. She inherited it from Sumner, and they didn't look like the merger was going to go through. But with the Trump administration receiving a what many would call a bribe from the participants, they green stamped the deal, and now it looks like they want to buy Warner Brothers Discovery. So, full disclosure, I used to represent a entity that dealt with Warner Brothers. So I worked at a firm, and the name partner had worked at Warner Brothers when, Time Warner back when it was Warner Brothers, and then he set up his own law firm, and had plenty of money from that and everything else he did. And we used to represent Time Warner Cable. It was a great company to work for. They always paid their bills on time. And unlike other cable companies that went bankrupt, like Adelphia, who was also a client, or AT&T, which got into a lot of trouble because it was over-levered by John Malone, Time Warner tended to do the right thing. So they are sort of acquiring a lot of content. And Netflix has so much content that it's difficult for all these other streaming services to compete with them. And Paramount has a couple of hit shows like that Western one, I forget what it's called. And so this $108 billion takeover would let them acquire a bunch of IP and content that would hopefully make their streaming service more attractive. And also would keep it out of the hands of Netflix because with more content, Netflix becomes even more attractive. But I don't know. I guess this is one to watch. Other really interesting news today is that in Berkshire Hathaway, Warren Buffett stepped down recently and said that he's officially retired in his 90s, and his deputies are going to run the ship. One is Greg Abel, who had been with him for a long time and was Midwestern Energy, and then they hired three T's. It was Ted, Todd, and Tracy. And Tracy was sort of the person that they would send in, sort of parachute in and fix some of the companies that were in trouble. And she eventually left to start her own like private equity thing, but focused on smaller cap companies that were not attractive enough to Berkshire because they were too small. And then it went from three T's to the two T's, Ted and Todd, and Ted Weschler, or I forget their names there, the Ted and Todd. But one of them had made the 10x on Dillard's recently. He got a 10x in 10 years, and it sort of demonstrated his patience because it was 10x in 10 years, but like the first 8 or 9 of those years, the stock went absolutely nowhere. And then at the end of that 10 years, it went up 10x, and people were mentioning what a genius that guy is. But that's not the guy who's leaving. The guy who's leaving is the other one. Let me look up his name. I forget his name, but it's announced that he is going to be hired at Todd Combs at JP Morgan. So JP Morgan is hiring him. So again, you had the three T's, Ted, Todd, and Tracy, plus Ajit Jain, who they thought, okay, Warren Buffett is one of the best investors and businessmen alive, and it would take 4 people to replace him. Now they're down to 2 people replacing him, right? So you got Ajit Jain and Ted Weschler, because Todd Combs is now walking out. He signed a deal with J.P. Morgan. So I don't know if that's great for J.P. Morgan because he is a great operator, but J.P. Morgan is also under Jamie Dimon, a very efficient ship. So I don't know how much more he can do for J.P. Morgan. But he does have the years of working directly for Uncle Warren, and he has Warren Buffett's seal of approval because the 4 people that he hand chose to replace him, this was one of them. So it's big news today that he's leaving and going to J.P. Morgan, but obviously got a sweet deal there. Thanks for the live chat. You're welcome. Probably won't be for very long. It's only going to go till 4:30 because I have stuff to do. But put in the chat any stock you'd like to talk about, and we can discuss it. I did mention I was looking at Copart recently, and there's another one that I'm looking at. I haven't decided yet. It's the ticker symbol is DOCS, and these it's sort of like LinkedIn, but it is. Hold on, let me see if I can find it for doctors. So it's a very interesting thing, and because it has a moat. I don't know. It's more expensive than I would normally pay for a stock, but it has a very interesting moat. So uh, the reason that you get more for ads on LinkedIn than you do on, say, Facebook is Facebook has a lot of housewives and teachers and plumbers or whatever. But if you want to advertise just to CEOs or just to doctors who make over 500,000 a year, or whatever, CEOs of Fortune 500 companies, they're all on LinkedIn. And so LinkedIn can get a lot more than Facebook Meta for the ads because you're allowed to target higher net worth individuals. Let's see. Bought HE a couple of months ago, got added to the S&P 600. It's up 10% this morning. Congratulations on that. Yeah, you normally get a nice bump when something is added to the index. And there's a stock that I own that was up about 4.5% today. Fairfax Financial that they keep talking about adding to the Canadian index. And I think when that happens, it'll go up a lot as well. But I was talking about this other company, Dox, and I haven't bought any yet, but I've been studying it, and it's a really interesting company. It's called Doximity, and the ticker symbol is DOCS, and it's sort of like LinkedIn, but just for doctors. So doctors and nurses, and I think like over 80% of doctors in the U.S. and like more than half of nurses are on it. And what's interesting about it, one, doctors make more money, and so it sort of has that appeal of LinkedIn, where you can charge a lot for ads, and two, the type of people that would sell ads on there are drug companies who have a lot of money. So it's not just people trying to sell scammy products like you see a lot on LinkedIn. It's drug companies, and they have this captive market with doctors and nurses. And it was as high as this year 85, and it's down to 49, 45. It's still at a pretty generous PE, 36.56. And I have mentioned before that anything you consider buying, you should compare to the default. And default is the S&P 500. And the S&P 500 normally trades at 15 times earnings, but now it's trading at about 30 times earnings. So it's kind of pricey, especially if you consider it has companies like Palantir, which has no earnings, or sorry, is trading at hundreds of times earnings. So 36 times for a little bit better than you would get investing in the index, it sounds pretty good. So Doximity has no debt, has about $1 billion in cash, and it's a $8.6 billion company. So more than 10% of their market cap is just in cash and no debt. I won't say no debt. I think they have like 11 million in debt, but way more cash than debt. And it has sort of this SaaS characteristic, software as a service, where people use it, and it's very sticky, and they tend to use it a little more every year than they did the prior year. So it's kind of like a ratchet. Like a ratchet only goes one way, right? You don't use less internet this year than you did the prior year. You tend to use more and more bandwidth. And Doximity seems to have that that characteristic with doctors and nurses. Like they go on there, and then the more they use it, the more they go on, because one, it lets them connect with other doctors and nurses, but two, it has other things, my understanding, that they can use it for, like when they transcribe their notes and things like that. That's the AI that they have, which will help them with that. And other specialty stuff for the medical industry, like if you have a patient and you need to find certain medications and how they affect other medications, or have certain symptoms that present for whatever, apparently you can use the AI to find studies, medical studies and things like that. So it's very interesting for that reason. As I said, doctors and nurses are very well paid. And if you have this thing where most of the doctors are on it, and drug companies can target them, and it's growing. And why is it down from 85 to 45 because it's growing, but it's not growing as fast as it was before. And we saw that before in a company I owned called Coupang, where it was growing like 50% a year. And then all of a sudden it's growing like 30% a year. And people were dumping the stock. But, normally you would give your left arm to find a company that's growing at 30% a year. So Doximity is still growing, but not as much as before. And I think the other sort of concern about it is that the total addressable market. So if you've got like 80 or 90% of the doctors and most of the nurses, and some hospitals require their physicians to all be on it, that's a great moat. Like nobody's going to switch to something else if everyone is on it. Like, there were people who tried to do competitors to Facebook. And I'm blanking on the names, but everyone's already on Facebook, so it's hard to get people to switch. And if you had to come up with a competitor to LinkedIn, it would be hard to get people to get off of LinkedIn because everyone goes there because everyone goes there. And this, they did a great job of attracting a certain niche, which is doctors. But if you've got 90%, like how much more can you get? And I think that's the concern that they have there is that it's sort of saturated, and even though you're going to use more 2 years from now than you did this year. If you've already got all the doctors, the only thing left is international expansion. And, what are you going to do there? So, I'm looking at that. I haven't pulled the trigger yet, but, it's an interesting idea, and trading at a little bit pricey for me. But, if you consider all the growth and stuff like that, I think it's interesting. And Copart, I mentioned I started looking at, and I bought a few shares while I study it. And again, that's the company that rolls up junkyards. Very interesting niche. Not really anyone competing with it except for a company called Ritchie Brothers, which is like Copart, but not as good. And let's see, Venture Global. I did a couple of videos on that, and it keeps getting beat up. Oh my God, it's down to 661 today. I should have bought some more shares. So, the same concerns it has that I did in the last call. And there's another guy, Dustin Dollars, who did a video on it yesterday where he walked through some of the numbers. And if you want to look for that one, that, I don't want to talk about the same thing over and over. Coupang came down from 30, and I was buying it at 25 and 26. It's 27 now. I'm not adding more because I'm out of money and I'm fully invested, but I still think 27 is a decent value, especially if I were to do something like buy long-term options or sell long-term puts, because I think over time it'll do really well. And, the things that happen to it tend to be short-term. So they had a data breach, and then the stock all of a sudden went down like 8% or 10% in one day. But if you look at prior data breaches in Korea and what they were charged, the previous huge data breach was a competitor, a telecom company, and I think they had to pay $100 million fine. So if it's this is like a little bit bigger than that, 30% bigger. So if it's $130 million fine, I think that's nothing a burger for Coupang. And I would if I had more available, I would buy at these prices. But there's things that are cheaper. Let's see. CROX was down a lot today for no reason. I think I mentioned I was buying heavily around 80 and below 80, I was selling puts and buying calls on it. So at 86, it's still reasonable, but not cheap enough for me to like open the wallet because there's other stuff so cheap right now, like Venture Global, and PayPal is very cheap now. And here's one that I mentioned before, DEA. So DEA is Easterly Government Properties. And I wouldn't put a lot of money in it, but I have some money in it. And as a reminder, this is the company that's a REIT, and it does government buildings. So it got taken out behind the woodshed and shot when the government was threatening to cancel leases and fire all the federal employees. And since most of their buildings are government buildings, it got beaten up. But according to Robinhood, it's paying a 5.5% dividend now. And there are things that to recommend it. Like their real estate is very valuable. And at least in the last two conference calls, they said they haven't seen any impairment in the amount of money coming in. So Donald Trump talks a big game, but a contract is a contract, and if you want to cancel a contract with them, you got to pay a lot of money. I think the only way they are exposed is if they move a government agency, like from they were threatening to move Space Force from Colorado to Alabama, because Colorado's a blue state and Alabama's a red state, and they want to punish blue states. But that didn't end up happening. But that was a big property that Easterly bought in Colorado, and so they thought, okay, that might be impaired, and that's part of the reason the stock price was down. But if you look at all their assets, I think it's trading at a very reasonable valuation here. So I do have not a lot. I've got like 6,000 and change of dollars worth of shares, just to monitor it and see if it goes better. And at a 5% dividend, I can be patient. And if I have nothing better to buy, this is a decent idea in my opinion, particularly because even before this election, they were focused on moving towards state government contracts as well. So if you want to move the Air Force or Space Force from Colorado to Alabama, that's an option. But if you're dealing with state buildings, the state capital of New York is in Alabama, and the state capital of Richmond is, Virginia is in Richmond. And, if you have a state contract and they say they're going to move it, like, well, where are they going to move it? They're not going to move it to Alabama. They have to keep it within the state. And some of these states aren't very large and have few big cities. So, I think if you are renting to cities, things like courthouses or jails, or administrative buildings, that's a pretty safe bet for Easterly government properties. And again, that ticker symbol is DEA. Let's see. Anybody have any stocks that they want to look at? I did mention Doximity. And if you go to Yahoo Finance, one of the things I like to do sometimes to get ideas is you go to markets and then go to stocks and put like the biggest gainers and losers in the day. And, you might find some interesting companies that are either oversold because on some minor bad news, like with Coupang, or overbought on some good news. So I just went to Yahoo Finance and I'm looking at the biggest gainers today. Wave Life Sciences, 140%. It's probably a drug company, so it's beyond me. And if you don't know these companies, you can look them up. But sometimes you'll find one that you recognize, like Warby Parker is up 13% today, and that's a great company. So you might want to look at it and see what is going on with it. Paramount was up because of the news that they were going to buy or try to buy Warner Brothers library. And that is very valuable, and it was supposed to go to Netflix, and if Netflix had bought it, that would be a lot of content and less reason for people to use the Paramount Plus app. But if they buy it, it's $100 billion worth of content that might make their system more attractive to subscribers. And if you go to markets, and now I'm going to go on the biggest losers today, and sometimes you'll find something that's oversold there. So Air Products and Chemicals, I know what that is, but I won't take a look. Comstock, do you have a view on Vistry in the UK? Housing program, if they're massive and affordable housing. Yeah, I looked at Vistry. I think the problem is that they oversold how good they are at affordable housing. And you can only sell affordable housing to the government, obviously, because it's not economical to build privately. And I looked at it over a year ago. I don't remember the numbers exactly, but I remember that was the issue, that in the pitch deck, they were predicting a certain amount in their pipeline and their skill set in acquiring these contracts because they had an in with the government. And if I recall correctly, it wasn't playing out, and that's when the stock got hit. But this was over a couple of years ago, and I don't remember the numbers, but correct me if I'm wrong, but I think that was the issue. So I wouldn't put a lot of faith in them, one, because, if they couldn't deliver before, I don't know why I should trust them now. And two, if you are dependent on the government for a certain source of income, it's one thing if you're in a position like Easterly government, where it's a REIT and they have these signed contracts and you're sort of using it like a bond substitute where, you have this coming in. But it's another thing where, your business model is predicated on getting new government contracts, and those government contracts depend on which political parties in power and how much they're willing to raise taxes and devote resources to that. So I think there's too many unknowns there. And then you have the currency risk also. There are some good UK companies that got beat up post-Brexit, and you can get them reasonably priced. And Greg's, for instance, I haven't looked at it, but somebody mentioned to me today, Greg's, which is sort of like not 7-Eleven, but like a very high-end 7-Eleven, like they bake their own bread. That might be an interesting one that for currency reasons got beat up, but I'd rather look at that than BERSKHIRE. I think their order book is already full for the next years. All right. Like I said, I'll take a look maybe for next time we can talk about it, but I haven't looked at it in a couple of years, and that's just what I remember from 2 years ago. Let's see. So looking at the stocks that are beaten up today, Unilever down 7%, and that's a consumer staple company. They make like soap and shampoo. There's probably not a good reason that it's down 7%, but worth looking at. Some mining companies, I pass on those because mine is a hole in the ground that's owned by a liar, as Mark Twain would say. But sometimes you can get lucky with that. VF Corp. That was a company that made bras and stuff, and it's a competitor to, or I think they may own Victoria's Secret, and they sort of shot themselves in the foot when they thought, anyone can be a model, and they started having models that if you went on a date and they showed up, you would just turn around and leave. And then there was some talk about them sort of revising the brand and going back to their roots with the Victoria's Secret angels and stuff like that. And I don't think it went anywhere, but for some reason it's down 5.5% today. So that might be worth taking a look. Although a lot of retailers are down recently, and if you want to look at a retailer that's sort of a turnaround story, I think Lululemon is a decent risk reward thing because let's see what's going on with VF Corp. VF Corp, it's trading at, it's a pretty high PE, probably because they're not making any money. And if you look at the 5-year chart, it's gone from 83 down to 19. So, Victoria's Secret, they don't sell like super high-end stuff. They sell like middle of the road to above average bras, but Lululemon, they sell $100 leggings, and they were trying to expand to men's and things like that. And they had, good luck moving from 0% or 10% men. So I think like 30-something% is now men's from Lululemon. So VF Corp down a lot today. But if I was dumpster diving, I think Lululemon is a better bet because it's very high margin stuff, very loyal customers. The stock got beat up due to tariffs because some of the stuff they make in Canada and some they make in China, and they were hit with tariffs. But if those tariffs get overturned, they should get a bunch of money refunded to them. And that's another reason I like CROX. So I mentioned CROX at 85, 86. I'm not going to buy more, but it's still 6 times free cash flow. So I think it's still a good risk reward thing, especially if those tariffs get overturned and you get that money back, and the company is priced like it's going under. 6 times free cash flow. Those are usually companies that are circling the drain. But this is a very good company, and it's not melting ice cube. It's actually shrinking. It's growing. Even if you count the terrible acquisition of Hey Dude, and in places like China, it's not big yet, but it's a very small part of their business, but it's growing 30% year over year. So, those could be huge growth areas for that. VF Corp, I would rather look at a company like CROX for that. And what else am I looking at? KRaken, I've done a few videos on, and I'm not buying more at these prices, but I'm just sitting and holding, and it's up 3.5% today. So I still like that. And I have a mid-sized position. I started in a small company called Table Track, and I did a video on Table Track. It's up 4% today. It's a very small company. At today's prices, it's only $18 million. So if you want to look into Table Track, don't you dare buy it with a limit order because you will get hosed. Small companies like this, you should only buy with a limit order because there's very little liquidity there. And so, even you buying a few $1,000s could move the price up significantly. So if you're ever looking at a company that's below $100 million, you should only use a limit order. And Table Track is one that I bought, and I have a medium-sized position in, and it's trading at a PE of 12, and they have no debt, and they have a bunch of their share price in cash. So it's $18 million. If you back out the cash, it's 10. So, almost half of their net worth is cash. So, although it says it's trading at a 12, it's probably more like a PE of 7. And their revenue is very lumpy, which is why it's gotten beaten up. So last quarter, they didn't sign any new contracts, but in the conference call, they said they have a contract, and because of the way when it was signed, it wasn't in the prior quarter, but it will be in this quarter. So if it got beat down a lot because they didn't have any new contract, then when the next quarter comes out, it might go up a lot. But this isn't something that I would trade in and out of because it's such a small company and, so illiquid that, if you're trying to acquire a big position or you're trying to sell off a big position quickly, it probably won't work out for you. But this, I think, is a good company to sit and hold for a couple of years. And what do they do? Table Track, they make casino management software. And it's a tiny company. And there are billion-dollar companies that sell software to the casinos, poker machines and whatever. And a lot of them give this casino management stuff away for free just because you bought the other stuff. But Table Track stuff is so good that they're willing to pay for it, even though they get it for free from other places. But as I said, this stuff is very lumpy, but it's very niche. So, it's an $18 million company. You're not going to have competitors in it because it's not a huge market. And half of their net worth is cash. And they have an incredible moat because with the casino stuff, in the U.S., you need a approval from the State Gaming Commission to have your software or equipment, anything in a casino. And they have it in Nevada, New Jersey, all these other places. Sorry, not New Jersey, but all these other places where you would need to operate. So not only is it a small market, but you would need several years to get the licenses that you would need. So that's an incredible moat for these guys. And also the software that other casinos give away when you buy like the poker machines and stuff like that, those have been hacked in the past. And, casinos have suffered huge losses. Table Track's their system is whatever the banks use. It's some really old software. I think it's called Fortran, where they don't even teach it in computer schools anymore. And so it's incredibly hard to hack because it's hard even to find people to program in it. But, once you have it, it's almost impossible to hack. Their stuff has never been hacked. So that's a great moat that they have. And, they have potential for overseas adoption because overseas, you're not required to have these same approvals from, the state gaming commissions, but they already have it. So it's kind of like the good housekeeping seal of approval. Astead. I know Astead. There's a guy, I think his name is Jeff Smith, really smart investor who I've met a few times at the annual meetings in Omaha for Berkshire Hathaway and in Toronto for Fairfax. And he's a big investor in Astead, and he's pitched it to me a couple of times. And I get it, but I don't get it. So Astead does what Berkshire bought a company called Van Tile, and they are auto dealers. And auto dealers are usually mom and pop operations, and a lot of the mom and pops are very old and they're dying. And so they can either give it to their kids, but sometimes the kids don't want to do it, or they can sell. And Van Tile, a company that Berkshire bought, is slowly acquiring companies like this. And they have a couple of competitors that do this, and one of them is Astead. So it is cash intensive to acquire these companies, but it is, according to, I think his name is Kevin, maybe it was Kevin Smith, profitable because once you have this, you've already got the systems in place. And so you're moving from a mom and pop operator to something that has hundreds of operators, and, you can have better logistics and billing and things like that, and HR all in one place. So that's part of the attraction of it. And two, a lot of these were built when cities were expanding. And so, if you built a car dealership on the outskirts of town and then the city developed around it, you have that, and it's very valuable. If you ever want to close a dealership, you can sell that. But if you're making a lot of money, like there's in Bethesda, a couple of really big car dealerships. But if you wanted to build something next to them, say these guys are making so much money, I'm going to do the same thing. You can't get that much empty land in Bethesda anymore. No matter how much you wanted to pay. And I think that's the appeal of Astead, as they're doing these roll-up transactions with these old mom and pops. And they think that they can do that profitably. I haven't looked at it in over a year. The stock price hasn't gone anywhere. If you listen to the conference call, they say they're doing well. And this guy, Kevin Smith, he runs a fund called Bonhoeffer, like the German philosopher. And you can find some videos of him where he's done like these presentations or these investor bets for his investors, where he's talking about Astead. And like I said, I've talked with him about it in Omaha at the Berkshire meetings, or in Toronto. I think his name is Kevin Smith. But yeah, just look up Bonhoeffer Fund and Astead, and you can find those videos. And he'll explain it better than I did. And he can give you the bull case. Like, I don't see it, and for a couple of reasons. One, they are moving some people like Tesla to this model where you can buy cars online, and that can sort of disrupt this industry if through litigation you have courts say that a car manufacturer now is entitled to sell cars directly to consumers. You don't have to go through the dealership, so that could disrupt their model. But the counter to that is, well, if they close down these stores, they have a lot of real estate that's very valuable. And the other thing is, as cars become increasingly electrified and self-driving, self-driving, you need fewer cars because 90% or 95% of the time that you own your car, it's not on the road. It's sitting in your driveway. So if people move to self-driving cars, they will need fewer cars in their driveways. And with electric vehicles, a lot of the money that all dealers make is through the service department. So, there's a saying that, they don't make the money when they sell the car. They make it on the warranty and the service department. And electric cars need a lot less service for the batteries because there's fewer moving parts. There's not an engine and transmission and things like that. It's just a giant battery and some wheels and something to convert the energy. So there's fewer things that you would need to take a electrical vehicle into service for. And so a company that makes a lot of money on the service department selling parts and having mechanics put it in, they could be exposed. So that's the negative to Astead. So I think that's it. Thanks for coming to the live chat. If you want to support the channel, there's a Buy Me a Coffee link, and there's also a link to Robinhood if you want to sign up for that. I have to get going because I have some stuff to do, but like and subscribe if you want to see more stuff like this, or if you've seen the videos I've posted with the stocks I've discussed, just leave a question there if you want to see a follow-up on that. And good luck investing, everyone.